Participants, first and foremost, I am thankful to Taxmann for allowing me this opportunity to share some of my thoughts on a very interesting and a developing topic in respect of the GST implications on the personal and corporate guarantees which are provided to the related entities. Now, before we start, let me just put the screen. Yeah. Okay. So the agenda for the next 1 hour would be like this, that first we will understand the entire concept of what we mean by the term guarantee. We will try and draw a distinction of this concept vis-a-vis certain other concepts which appear to be similar to this concept, but they are in fact not so. So once we have a fair bit of understanding of what exactly the guarantee means, and we get into the provisions of the GST law, we look at the charging provisions, we look at whether there is a supply that happens during such transaction. Once we sail through that aspect, then we go to the GST implications. We broadly divide the implications into two buckets. One, we deal with personal guarantees which are given by the directors or the shareholders, the majority shareholders of the company, to the banking companies, to the financial institutions in respect of the loans which are advanced by these institutions to the given company. Then we look at the second bucket, which is a corporate guarantee, which is generally given by a holding company to a bank or a financial institution for the loans which are advanced by these institutions to their subsidiary companies. We look at various nuances on this particular aspect. We also consider this aspect in two principal time zones. One is pre-26th October 2003, and the other is on and after 26th October 2023. This date is very important for the reason that there has been an amendment in the GST rules, specifically Rule 28, dealing with the valuation provisions in respect of supplies that happens between related persons. That is the reason why we discuss the implications in respect of corporate guarantee in these two time frames. And lastly, we look at various open issues. Several issues are there, which I'm sure many of the participants would also be having in their minds. So we touch upon those issues. We touch upon what may be the possible way to deal with those issues, what may be the possible solutions to those issues. And in the end, if time permits, we can certainly have some questions. So now, without wasting much time, let us look at the concept of guarantee. Specifically in our context, the transactions that we refer as guarantee are governed by the provisions of the Indian Contract Act. Section 126 of the said Act defines the term guarantee. It says that a contract of guarantee is a contract to perform the promise or to discharge the liability of a third person in the case of his default. So essentially, the concept is like this, that there are three persons involved, A, B, and C. A is supposed to perform a promise or a discharge of liability against B. B, for our case, would be the financial institution or the bank. And C is the person who guarantees B that in the default of performing the promise or the discharge of the liability by A, C will perform that obligation, C will discharge that liability. So essentially, a concept of guarantee or a contract of guarantee essentially involves three parties. Now, the Contract Act under Section 127 says that in such situation, it is not necessary that the C must be compensated separately for undertaking this obligation of discharging the dues or discharging the liability of A. Section 127 says that it is sufficient consideration for the promise performed by B against A in terms of, in our case, for ease of reference, the granting of loans. That is a sufficient consideration at the hands of C to perform or to take the obligation of guaranteeing the repayment of that loan. in case of default by A. So section 140, however, says that once the guarantor discharges the obligation on failure of the discharge of obligation by the principal debtor, then in that situation, the guarantor then steps into the shoes of the creditor, which is the bank, and whatever rights that the bank had or that financial institution had against the debtor, all those rights would get invested with the guarantor, and then it is the guarantor who will then subsequently proceed against the principal debtor to recover whatever is permissible under the law against the payment that or against the obligation that he has settled with the creditor, which is the bank. So essentially the contract law, to summarize at this point in time, says that there is no separate consideration which is required at the hands of guarantor to take this obligation of performing the promise or discharging the liability of a principal debtor against the creditor. There is a sufficient consideration if the creditor has given certain or has taken certain obligation vis-a-vis the principal creditor. So this is the contract law. It generically defines the concept of guarantee. Now let us look at how the corporate world has evolved on this particular aspect. Now, what we are discussing as far as this session is concerned is financial guarantees. If we apply the definition that we saw in the Contract Act, in the context of financial guarantee, it would be a guarantee which is a legally binding promise which will be made by a party, generally a holding company, to pay to the lender in this on account of default committed by the original borrower. Now, why the financial institutions seek this kind of guarantee? Essentially, the financial institution basically needs to ensure that the loans that they are extending to the borrower are repaid by that borrower. And in case of failure of the repayment by the borrower, then the recourse is available with this financial institution to recover the amount from the guarantor who has given the guarantee. Now, giving the guarantee essentially improves the credit rating of the borrower because in absence of a guarantee, it is quite possible that the bank or the financial institution may not extend the borrowing or may not give the loans to the borrower. It is also possible that not only the credit rating is improved in terms of allowing access to funds at a cheaper rate of interest, it is also possible that because of the guarantee given by the holding company or maybe the directors or the shareholders, the entity is able to secure a larger volume of debt as opposed to a situation where in absence of such guarantee, probably the amount of debt or the amount of loan which otherwise the borrower could have taken would have been on a lower side. So essentially, two major advantages are derived by the borrower, where a guarantee is given by a related entity to that borrower, to the banks or the financial institutions, namely a favorable rate of interest as well as larger volume of debt than otherwise what is available in case of a transaction where such guarantee is not given. Now, before we get into the legal implications of the transactions that we just discussed, it is very important to understand and differentiate a financial guarantee, which we will be discussing henceforth, and the GST implications on that financial guarantee vis-a-vis other forms of passive association between the related entities. So there are essentially three major kinds of passive associations that related entities may have in respect of seeking the finance from third parties, as essentially the financial institutions in our discussion. So first, passive association basically is a group association. So let us say there is a group Let us say, let us take an example of Adani. So it is a group of companies which are recognized in the market as Adani Group. Now, a subsidiary of this group approaches the financial institutions for seeking loans by virtue of the association of that company with the Adani Group as a subsidiary or as a sister concern. It is possible that that particular entity may derive benefits which are normally not available to a similarly situated company which is not associated with such group. So this is essentially a benefit derived by being part of that larger group of companies. Now, because of this fact, it is quite possible that the credit rating of that particular entity might get improved and therefore might able to get borrowings on better terms or at of a larger volume. But please understand, in this kind of situation, the financial institution has no enforceable right against the group or against the parent entity. If there is a default committed by that entity against whom that loan was advanced, the financial institution would have the enforceable right only against that entity, despite the fact that that entity is part of the group and that might have played certain role in terms of determination of the credit rating or the volume of debt which this particular financial institution has extended to that particular entity. But in absence of any enforceable right, this stands as a part of a passive association, not an active association. So this is the first kind of association that one should keep in mind. Second is letter of comfort. Again, it is quite possible that the financial institution may say to this kind of entity that, look, you are part of this group, you are a subsidiary of a holding company, so kindly get us a letter of comfort from the holding company. Again, this kind of transaction is a passive association for the reason that no enforceable right is vested by virtue of such letter of comfort. The financial institution cannot go against the parent entity in case of default, which is committed by this particular subsidiary entity. Third are again by nature are recognized as a guarantee, but maybe having a passive association. So we can broadly discuss two kinds of situations in this category. One is a situation where, let us say, mechanically the financial institution seek a corporate guarantee from a holding company while extending the loans to the subsidiary. It is quite possible that this is because of the inflexibility at the end of the financial institution and certain procedural protocols which are in place, which leads to this situation. Essentially, the guarantee given by the holding company in such situation does not affect the credit rating of that entity, or essentially doesn't play any role in terms of the volume of debt which is extended by this financial institution to that subsidiary company. So this is a kind of a transaction where it appears to be a financial guarantee, but it is a passive association for the reason that such guarantee has not essentially played any role as regards the borrowings which have been made by the particular subsidiary entity. Another is a situation where, let us say, the financial company extends the loan to the borrower principally on the strength of the guarantee given by the holding company. The borrower per se doesn't have adequate security to support that kind of loan. So principally, this is in real world recognized as an equity contribution by the guarantor, in the sense that the bank or the financial institution knows from start that the subsidiary company is not creditworthy enough to extend such kind of loan. But because considering the creditworthiness of the holding company and considering the fact that the holding company has given a guarantee, which is an enforceable guarantee. So essentially, in substance, it is a loan given to the holding company. The holding company, in fact, has infused that amount in the subsidiary by way of an equity capital. So that is the real nature of the transaction, although on paper, it is structured as if it's a borrowing made by the a subsidiary company from the given financial institution. So this is again a kind of guarantee which is recognized as a passive association for the simple reason that this is considered as a equity contribution by the holding company to the subsidiary company and not considered as a financial guarantee for the normal or for the borrowings which are made by the subsidiary entity. So these are the passive associations. When we look at the issues a little later, we will understand whether GST has any implications in such situations where the association is passive in nature and not active in nature. Then we also have another form of guarantees which are non-financial guarantees, which are essentially performance guarantees. These are the guarantees given against certain obligation in terms of work which is to be fulfilled. These are not the guarantees which are for our discussion because these are non-financial guarantees. These guarantees get triggered essentially when there is a breach in terms of execution of the work to be performed under a particular contract. Now, when we look at financial guarantee, we look at first the key principle which goes into the determination of the guarantee fee. Now, from where we are deriving this principle? We are deriving this principle from the literature that we have from OECD, the literature that we have from the legal precedents that we have under the income tax law, principally concerning the transfer pricing regulations. The sum and substance of all these guidelines and the judicial decisions that we have boils down to this particular principle, and that is that ultimately the guarantee fee should have a nexus to the advantage which is secured by the borrower. The essential reason, as we discussed earlier, for giving the guarantee is to enable the borrower to get loans at an attractive rate of interest or to get loans of a higher volume than otherwise would have been permissible if that entity would have, on its own merit, would have tried to approach the banks and sought the loans. So essentially, the guarantee fee has to have a correlation with that advantage. Let us say if there is no advantage which has been derived by the borrower, by the subsidiary company, then in that situation, one cannot say that there is essentially a transaction where there is a necessity of payment of any kind of fee or consideration against the action of guarantee which is performed by the holding entity. But at the same time, it is also important to understand that by applying this principle, it should not happen that the quantum of guarantee fee is such that the financial position of the borrower, that is for our discussion a subsidiary entity, is worsened because of this guarantee related cost. So ultimately a balancing has to happen between the benefit which is derived by the borrower and at the same time the quantification of that benefit should also be not enormous to the effect of worsening the position of the borrower. This is again for the simple reason that it should not be the case where a borrower in a non-related party transaction or an arm's length transaction would certainly not get into a transaction where the borrower obtains the loan, pays the guarantee fee, which is disproportionate to the benefit which the borrower is deriving from that guarantee, and at the end of day finds itself in a situation which is worse than the situation where the borrowings were not made. So that is essentially the principle that one has to keep in mind while deriving the guarantee fee. What are the approaches for determination of this guarantee fee? If you look at the transfer pricing regulations, essentially 4 approaches are suggested. One is the yield approach. This essentially is applicable when the principal benefit which is derived by the borrower is in terms of reduced rate of interest. So essentially it says that in absence of guarantee, if the borrower had to pay a rate of interest of, let us say, 8%, and it is by virtue of the guarantee given by the parent that the rate of interest gets reduced to 7%, then the benefit of 1% that it has derived by virtue of the guarantee given by the parent would be the critical factor for the determination of the value of the guarantee fee. Of course, that entire 1% cannot be equal to the guarantee fee because ultimately that entire advantage has to be shared between the guarantor and the borrower. So essentially a profit split method would have to be invoked once the benefit is quantified so as to appropriate the benefit between the borrower and the guarantor in terms of the bargaining power of each entities. Then the balance three approaches, that is the cost approach, the expected loss approach, and the capital support approach. These are the approaches which determine the valuation based on the guarantor's side of event, and not essentially based on the benefits derived by the borrower. So when we look at the cost approach, it is essentially looking at the cost incurred by the guarantor while giving the guarantee to the banks or financial institutions. Expected loss approach essentially looks at the statistical approaches to derive the expected loss, in a sense where the guarantee is triggered and the guarantor is made to discharge the obligation of the borrower, and also is unable to recover that amount from the borrower. In that situation, there is an expected loss that may happen by virtue of the guarantee given, and therefore that aspect is ultimately, through a statistical analysis, is quantified, and to that extent it is derived that this is the amount of expected loss that the guarantor is taking on its head while issuing such guarantee, and therefore the guarantor needs to be compensated basis the quantification of the expected loss. And then we have similarly a capital support approach. So essentially, we look at these approaches. We have a borrower side approach and a guarantor side approach. A borrower side approach is the yield approach, and a guarantor side approach is essentially the cost approach or the expected loss or the capital support approach. This is the way this issue has been looked at from the perspective of transfer pricing when we look at in the context of direct taxes. Now let us look at, just keep this background in mind. This was just a background. Now we look at the provisions of the GST law, and we look at how GST law looks at this situation, and what is the recent amendment that has happened on 26 October 23, and what are the implications of those amendments. Now, before we deal with the implications, let us first look at the charging provisions under the GST law, because we need to first examine whether is there a charge when a financial guarantee is given by a guarantor against the loans which are extended to the borrower. So when you look at charging provision, section 9(1) of the CGST Act provides for the levy of tax on all kinds of supplies. The scope of supply has been defined under section 7. Section 7(1)(a) essentially includes broadly all kinds of supply which are made in the course or furtherance of business for a consideration. And clause C, which is relevant for our discussion, is that it includes within the scope of supply certain activities which are specified in Schedule 1, which are made or agreed to be made without a consideration. Therefore, clause C, in a sense, says that whatever activities which have been specified in Schedule 1 that would come within the scope of supply, irrespective of whether the activities have been made with consideration or without a consideration. So the aspect of consideration is taken out when it comes to the activities which are specified in Schedule 1. Now, when we look at Schedule 1, entry 2 becomes relevant. Entry 2 says supply of goods or services between related persons would be considered as part of this schedule. Now, when you look at the definition of related persons, explanation to section 15 defines that expression. If you see clause A of this explanation, and if you see subclauses 1, 4, 5, 6, and 7, they are very broadly worded. It includes within the expression related person, the transaction that happens between the officers and directors. It includes transactions that happens when one entity owns or controls at least 25% or more of the voting stock or shares. It includes transactions where one of them indirectly or directly control the other, or where both are controlled directly or indirectly by a third person, or where both the entities directly or indirectly control a third person. So a very generic definition is there in law. The expression control has not been defined in the GST law. So essentially, when we look at the transactions where transactions happen between a holding and a subsidiary company, it would come within the scope of the expression related person, because certainly the holding company is controlling the subsidiary in terms of having the ability to appoint the directors, the board, which runs the subsidiary, and therefore there is certainly a control, that is a direct control, which is there between a holding and a subsidiary company, and therefore both would be considered as related persons for the purpose of GST law. Similarly, directors would be considered, or the employees which are in the capacity of working as a directors would be considered as related persons in the our context. Similarly, a major shareholder and the company would be considered as related persons, because major shareholder would be in a position to directly or indirectly control the company, and therefore again both those entities would come within the scope of this expression related persons. So now essentially when we look at the charging provisions, what we find that there is no specific provision providing for the levy of tax on transactions of giving financial guarantees by a holding company for the loans extended to the subsidiary or to related persons. However, the way a deeming fiction has been created under Schedule 1 to say that supply of services between related persons would attract GST even if they are made without consideration. So the aspect of consideration would be irrelevant if one is able to identify that there is indeed a supply that has happened between the related persons. At this stage, to sum up, one can say that the levy of tax is certainly there where there is a supply. Aspect of consideration has only been negated when we look at Schedule 1, Entry 2. So when we look at this provision of law and apply it in our context, what we find is that where there is an active association, where by virtue of financial guarantee, certainly the state of borrower has been affected in terms of either borrower being able to get attractive terms or being able to access larger volume of debt. One can very well say that this is a transaction which is in the nature of supply between the related entities, and therefore even if no consideration is charged by the holding company for extending such guarantee, this transaction would come within the ambit of GST and therefore would become liable to tax. When we look at the issues, we also look at the aspect where as to whether this particular law can be applied in a situation where we have passive association as opposed to active association. But as far as active associations are concerned, we are of the view that certainly GST would be applicable in a transaction that happens of giving a guarantee where a related person is involved. Now, having said that, now let us look at the implications. So as we discussed, the implications are divided into broadly two categories. One is personal guarantee and the other is corporate guarantee. Now, when we look at personal guarantee, I will not again take you through the law. We already seen the law. We already seen that the directors or the major shareholder in the company would be related person, and therefore a transaction between those related persons would be liable to tax even in absence of consideration. Now, let us look at what the circular 204 says. This was the circular which was issued on 27th October 23. The circular essentially deals with three important aspects. First aspect that the circular says that indeed there is a supply that happens between the director when the director gives a personal guarantee against the loans advanced by the banks or financial institutions to the company. So the aspect of supply has been found in such transaction. However, the circular then takes recourse to the RBI circular dated 9th of November 21, where the RBI says that in such situation, no consideration should be paid by the company to the directors in lieu of personal guarantee which is provided by such directors. And in that context, the circular then refers to Rule 28 as was in existence and then says that where no consideration has been charged by such director against the company for providing such guarantee, and therefore the rule necessitates that the consideration has to be based on the open market value. And then the circular draws reasoning from the fact that since the RBI prohibits payment of any kind of commission or fees to such directors, the open market value of such transaction is nil. And since no consideration can be paid, and in view of nil open market value, the circular takes a position that GST would not be applicable on such transaction only on the ground of nil value or the open market value being zero. The circular also recognizes that in a situation where, let us say, actually there is a payment made by the company to the director where the terms of loan permit such payment, or where the director has ceased to remain a director, but still continues the guarantee which was issued to the financial institution against the loans which have been advanced to that company. In such situation, the circular takes a view that where remuneration is paid or where any consideration is paid, and in such situation, GST would be applicable on given transaction. So in a way, the circular deals with three important aspects. One, it confirms that there is a supply between director and the company when the director gives personal guarantee. However, the circular says that in view of valuation provisions where Rule 28 says that the valuation has to be based on open market value, circular takes recourse to the RBI circular to say that since no consideration can be paid, the open market value is zero, and therefore the transaction cannot be subjected to tax. Circular also recognizes that where there is actual payment, GST would be payable on the transaction value. Now, let us look at corporate guarantee implications. So, corporate guarantee implications, as we discussed, are broadly divided into two categories. One is pre-26th October 23 position, and another is on and after 26th October 23. Now, before 26th October, as we discussed earlier, certainly there is a levy of GST, because as we discussed, in case of an active association in terms of giving a guarantee, there is a supply happening between the related persons, and therefore the transaction would be liable to tax. Now, when it comes to valuation, since the transaction is between related persons, section 15 subsection 1 says that the transaction value would not be the value of supply. In such situation, the valuation will have to be done taking recourse to 15 subsection 4. 15 subsection 4 grants power to the government to prescribe the manner in which the value of supply is to be determined. Basis this provision, Rule 28 has been formulated, which says that in such situation, this is the rule that we are discussing prior to the amendment that happened on 26th October. So basis this, the rule says that the valuation would be the open market value. However, there is a proviso attached to this Rule 28. The second proviso, which also you can see on the screen, which says that where the recipient is eligible for the full credit, then in that situation, the value that you declare would be the open market value of the concerned goods or services. Now, so having said that, this is the law which we had prior to 26th October 23. Now, on and after 26th October 20, there has been a shift in the manner in which the value is to be determined in such situations. A new sub-rule has been inserted into this Rule 28, which essentially overrides the sub-rule 1, what we discussed in the earlier slide. And this new rule essentially says that the value of supply of services, when the supplier and the recipient are related person, by way of giving corporate guarantee to any banking company or a financial institution on behalf of the recipient, shall be deemed to be 1% of the amount of such guarantee offered or the actual consideration, whichever is higher. So a deeming fiction has been inserted in the valuation rules to say that when a transaction of giving a corporate guarantee to a banking company or a financial institution is between a related person, then in that situation, the value of supply would be deemed to be 1% of the amount of guarantee offered or the actual consideration, whichever is higher. So a deeming fiction has been created by virtue of this amendment, which was made by notification 52 by 2023. Now, in that context, a circular came to be issued on the very next day after which this notification was issued. That is circular again 204. Now, what the circular says, essentially in the context of corporate guarantee, it again says, as we discussed earlier in the context of personal guarantee, that there is indeed a taxable transaction that happens when such corporate guarantee is issued. It says and recognizes that there were different practices which were followed by the field formations and taxpayers in the determination of such taxable value prior to 26th October 23. And therefore, to provide uniformity in these practices and to provide ease in implementing this particular provision, it is with that idea that this sub-rule 2 has been inserted with effect from 26th October 23. And then it essentially says that it is consequent of insertion of this particular new rule that in that situation, the valuation would be henceforth as per this particular new rule, that is either 1% of the amount of guarantee or the actual value, whichever is higher. So this is essentially what circular clarifies. Now let us look at the issues that we have. There are numerous issues that one will have to deal with when one ultimately examines this situation vis-a-vis the respective entities. So as we discussed earlier, there can be two kinds of association that may happen between the related parties when we look at it from a financial transaction standpoint. One is an active association that we already discussed, that in our opinion comes within the scope of supply and therefore would be liable to tax. The question related to valuation and all of those questions are what we will discuss henceforth once we deal with this issue. However, where there is a passive association, where we discuss that by being merely associated with a group, or in terms of letter of comfort, or in terms of a guarantee which essentially does not affect the borrowing which has been made by the related entity. And in that situation, in absence of any benefit derived by the related entity, is there a levy of tax, or is there a supply that can be said to happen between the related parties? Now, as we discussed earlier, fundamentally, the Schedule 1, Entry 2 only house or only excludes the aspect of consideration. It still mandates that there must be a supply that must happen between the related persons, and only in that situation that can be liable to tax. So can we say that in absence of any benefit derived by the borrower, or by mere virtue of association with the group, or by virtue of letter of comfort where there is no benefit derived, can there be a supply that can be said to take place between the given related entities? If you see the latest OECD guidelines on this aspect, the OECD guideline has recognized that in such situation, it is possible that some incidental benefits may be derived, but in absence of any enforceable right which is available with the banks or the financial institutions to go against the guarantor, or against the person who has issued the letter of comfort, or against the person or a holding company which is part of that group. In such situation, the OECD guidelines have recognized that in absence of any tangible benefit, and in absence of any enforceability, such transactions would not tantamount to a supply of a service that can be said to take place between the related entities. So in India, we don't have a jurisprudence which fully developed on this aspect, but we have international jurisprudence. You can see a couple of rulings from Canada and Australia, where there the courts have recognized this distinction between an active and passive association and came to the findings that in case of an passive association, even if there are certain incidental benefits which are derived by virtue of the passive association, still it cannot be said that there is a supply of service happening between the entities of that particular group, and therefore in that situation, no further adjustment in terms of transfer price is required. So this can be applied even in our context, in the context of GST, to say that if there is no benefit derived by the borrower by virtue of the guarantee given by the holding company, and in that situation, it cannot be said that there is a supply that has been contemplated between these two entities, and in absence of supply, the levy of GST would not be applicable. So that is first issue that one needs to consider, and one needs to draw a distinction between this active and passive association. Second issue to consider is in the context of personal guarantee. Now, the shareholder very interestingly only refers to the personal guarantee given by the directors. It fails to refer to the personal guarantee which is given by the major shareholder. And when you look at this particular transaction, what essentially happens is that the banks or the financial institutions are not just looking at the guarantee of a director, unless the director is a major shareholder, because unless the director has a major stake in that company, then only the director will have that kind of wherewithal to ultimately repay the loan in case of failure by the company to discharge the liability. So essentially, the director shareholders or a major shareholder who may not be the director, essentially should stand at the same footing. The circular which has been issued fails to recognize a shareholder who is not a director and therefore does not deal with that situation. Our reading of the RBI circular suggests, and why we are referring to RBI circular, because as we discussed earlier, the circular, in fact, the CBIC circular refers to RBI circular to arrive at a conclusion that since there is a prohibition or a restriction of making any payment of commission or any fees for such personal guarantee, there is no consideration and therefore the transaction would not be taxable. If you see the RBI circular, essentially para 2.2.9, our reading suggests that it is not limited only to the personal guarantee given by the director. The RBI circular even extends to the personal guarantee given by a shareholder who may not be the director in that particular entity. So to our mind, the reasoning given in circular, CBIC circular, should also equally apply in case of personal guarantee given by a shareholder who may not be the director, and therefore in view of the fact that the RBI restricts payment of any kind of fee or a commission for such guarantee, there cannot be any transaction value and there cannot be any open market value, and therefore the transaction should not be liable to GST. However, as we are suggesting that it is always advisable to ask the banks, in fact RBI circular also mandates that the bank should also put this very clearly in their agreement while sanctioning the loan, that no payment of fees or commission should be made to the guarantors of that particular loan. So that kind of it is advisable that should be expressly stated in the sanctioning letter or the sanctioning agreement, so that it can also be relied upon to say that there is an express prohibition on payment of any commission to any of the shareholders, and therefore in that view the transaction value or the open market value would be zero, and therefore applying the reasoning of the circular, the transaction not be liable to tax. Now, interesting issue that arises is in the context of corporate guarantee. Now, as we discussed earlier, there is certainly a levy of tax. There is certainly a change in the valuation mechanism pre 26 October 23 and post on and after 26 October 23. But before we get to that, it is essentially important to understand how this new valuation provision would apply in the context of particular guarantee in question. Now, as you are aware, fundamentally one has to understand that the liability to pay tax on services, why we are discussing services, because this is a transaction essentially of services. Section 13(1) specifically provides that the liability to pay tax on service shall arise at the time of supply as determined in accordance with the provisions of this section. So it is the time of supply and the provisions of the law as applicable on the time of supply that would govern the determination of the liability to pay the tax. When you look at 13 subsection 2, it essentially says that the time of supply would be A, where the invoice is issued, the date of invoice, or the payment, whichever is earlier, if the invoice has been issued within the prescribed time. B, if the invoice has not been issued within the prescribed time, then in that situation, it would be the date of provision of the service or the date of payment, whichever is earlier. And then C, it says that if A and B are not applicable, then in that situation, the date on which the recipient shows the receipt of services in his books of accounts. Now, here one has to understand that in a situation which we are discussing, it is the date on which the guarantor executes the guarantee agreement and therefore takes on the obligation to repay the loan in case of default committed by the related person. Then in that situation, that date to our mind can be considered as the date on which the services are provided. To support this thesis, one can look at several decisions of the tribunals in the past, where the tribunals have consistently taken a view that in such transactions where the agreement or the execution happens on day one, but the obligation continues for a period of time, then in that such situation, it can be said that the date on which that obligation was undertaken, that is the date on which a service would have been considered to have been provided, and it is the obligation arising out of that service is what survives over a period of the contract. So if you look at the insurance contract, if you look at the yearly maintenance contract, they are of similar nature, where on day one, the obligation is taken by the supplier, whereas the tenure of the contract continues over the span indicated in that agreement. So to our mind, if you see and apply section 13(2)(b) to our situation, then one can safely say that it is a date on which the obligation was taken by the guarantor as the date on which the service can be said to have been supplied. And therefore, it is the law at that point in time that would govern the determination of the liability to pay the tax. Now, we also have section 142(11) clause B. There is a transitional provision which says that to the extent the tax was leviable under the earlier law, that is the Finance Act 94, then in that situation, the tax shall not be again payable on the services which are supplied under the during the GST period. Now, applying these two provisions of law, now let us look at what possible view one can have. So one is a situation where, let us say, a guarantee has been executed prior to GST implementation, that is prior to 1st July 2017. In this context, one may consider applying section 142(11)(b) to say that there was a tax which was leviable. The language used is very broad enough under 11(b) to say that only aspect to be determined or to establish is that there was a tax which was leviable, not that tax was actually levied, because in the service tax law, we didn't have a provision similar to what we have in context of entry 2 to schedule 1. And then we have a decision in the case of Supreme Court in the case of Edelweiss, where the Supreme Court has taken a view that in such transactions where there is a corporate guarantee provided, in absence of consideration, it cannot be levied to tax. But it was leviable. And therefore, one can say that in a situation where the guarantee was executed prior to July 17, tax was leviable. Whether it was actually levied or not depends on whether consideration was charged or not. But since it was leviable, one can very well say that that transaction goes outside the ambit of GST. And therefore, even if the guarantee survives today or extends to the GST period, since the taxing event, the charging event had already triggered prior to the introduction of GST, in that situation, that transaction by virtue of section 142(11)(b) comes out from the ambit of GST law. Second is a situation where we have transactions that have happened between 1st July 17 and 25th October 2023. And third is a set of transactions that will happen or has happened on and after 26th October 23. Now, why we are bifurcating transactions during the GST regime into these two buckets? It is for the simple reason that, as we saw earlier, there has been a shift in the way in which the valuation has to happen. Now, when you look at the charging provisions, section 9(1) essentially says that the levy is on supply on the value which is determined under section 15, and it shall be paid by the taxable person. So section 9(1) is a complete code by itself, not only identifying the taxable event, also identifying the value to be derived for purpose of determining the liability and the person who is supposed to pay the tax. So all the three essential elements of the levy are essentially dealt by 9 subsection 1. And as we saw, section 13(1) expressly uses the language that the liability to pay tax arises at the time of supply. So what we are coming to is this proposition that the valuation provision under section 15, where we saw that by virtue of section 15 subsection 4, earlier rule 28 talked about open market value and had a proviso to say that if the full ITC is available to the recipient, then whatever value indicated is the value of supply. That law would be applicable to the transaction that have happened between this period of 1st July 17 to 25th October 23, because it is during this period that a supply was made. On the date on which supply was made, there was a need of determining the value under section 15. So it is the provisions of law as applicable under section 15 on the day on which the supply was made is to be applied, and basis that application, the amount of tax to be paid needs to be determined. So putting everything together, one can have a view to say that in a transaction where the guarantee has been executed during this intervening period from 1st July 17 to 25th October 23, one can very well say that the amendment would not apply. The amendment to Rule 28 would not apply even if that guarantee subsists after 25th October 23. And therefore, this transaction would get governed by the earlier rule. And basis that earlier rule, if full credit is available, then even nil value has been found to be acceptable. We already have a board circular in the context of transactions between distinct person, circular 199. We have similar rule 28 is the very rule which deals with transactions between related persons as well as distinct persons, and therefore one can take recourse to this circular to say that even nil value is a value as long as full credit is available. And in such situations, the guarantees which are executed between this intervening period would get governed by the earlier valuation rule. It is only guarantees which are given on and after 26 October 23 that they would be governed by the amended provisions. Now, there is a further contention to this particular proposition is this, that when you look at circular 204, it very well recognizes that prior to 26th October 23, there were certainly different practices which were followed by the field formations as well as taxpayers. And the circular categorically recognizes that it is henceforth, that in a supply happening henceforth, that the new valuation provisions would get applicable. So it is a substantial amendment. One cannot say that it is a retroactive amendment or a retrospective amendment. And since it is an amendment dealing with valuation, and as we discussed, section 9(1) is a comprehensive code which applies the provisions of law as on the date on which the supply happened, as on the date on which the charging event happened. One can consider taking a proposition that in such situation, the amendment applies only after 26th on and after 26th October 23 and not to the transaction that has already happened prior to 26th October 23. Now let us look at certain other issues related to this amendment that has happened. Now, as we discussed earlier, the amendment creates a deeming fiction. It says 1% of the amount of guarantee offered or the actual consideration, whichever is higher. This is the valuation that the amendment wants to apply. And this amendment overrides sub-rule 1. Therefore, now we don't have a recourse after 26 October 23 to say that if the full credit is available, then any value on the invoice can be deemed to be the open market. I mean, this situation, there can be numerous issues. One issue is that whether this 1% is to be charged on the guarantee offered or only to the extent of obligation of the guarantor, because it is quite possible that on day one, when the guarantee is offered, the outstanding amount could be 100 crores. But as the time progresses, the outstanding amount, because of the repayment which are done by the borrower, comes down. And in that situation, the liability of the guarantor also to that extent gets reduced by virtue of the repayment of the loan. In that situation, whether 1% would continue to be charged over the entire duration of the guarantee on the basic amount, or it has to be charged sequentially on the lower amounts, considering the payments done by the borrower. Another issue which is also to be understood is that in case where we have multiple guarantors, there are situations, live situations, where it is quite possible that there may be two guarantors. In that situation, is it the requirement that both the guarantors should charge 1%, or is it the case that in such situation 1% should be the total amount charged? And therefore, in a situation where we have two guarantors equally sharing the burden of meeting the obligation on the failure committed by the borrower, in that situation, then in both the guarantors should charge 0.5% and not 1%. Third issue, which is again very important, is that whether 1% is to be charged on an annual basis or is it a one-time charge. The rule lacks clarity. The rule doesn't say that the 1% is to be charged annually. However, when you look at the transfer pricing guidelines that we have and the safe harbor rules that we have, from where this 1% appears to have been borrowed, there the provision is to make charge of 1% on an annual basis. So every year, to the extent of the guarantee which survives, 1% has to be charged. Another interesting aspect which has to be also kept in mind is that whether this deeming fiction of 1% in a situation where you are able to ascertain the actual value and if it is found to be less than 1%, in that situation, whether you are still governed by the deeming fiction, as we saw earlier, there are different valuation yardsticks which are available to determine the value of guarantee fee. Let us say by applying those yardsticks, you arrive at a value which is much lower than the 1% which is deemed under subrule 28 subrule 2. Then in that situation, are you still bound by this deeming fiction, or you can take recourse to the basic provisions of section 15 to say that the scheme of the act is to levy tax on a transaction value. And if you are able to determine a transaction value, and if the department is not able to question that value, then in that situation, whether a recourse to deeming fiction is still necessary or not. We already have decisions of Supreme Court in the context of customs law, where the Supreme Court in Wipro Limited has taken a view that in a situation where a person is able to demonstrate the actual value, actual cost, then the assessment has to be made on the actual. Deeming fiction can be resorted to only in a situation where the person is not able to ascertain the actual amount. So one can consider applying that ratio to this situation to say that in such situation where one is able to demonstrate the actual consideration, if it is lower than 1%, then one can go with that lower amount and need not be still bound by the minimum 1%, which is otherwise indicated in Rule 28.2. Couple of more issues before I close. One is an issue concerning this applicability of this deeming fiction to a transaction where the transaction happens between entities or the banking companies which are located outside India. Now, why this issue arises? See, this issue arises for the simple reason that when you look at the subrule 2, it says that it applies in a situation where the transaction is by way of providing a corporate guarantee to a banking company or a financial institution. Now, this expression banking company and financial institution has not been defined. Now, we have a definition of this expression in section 13 subsection 8 of the IGST Act, which deals with the determination of place of supply. Now, this explanation clearly says that this is only restricted to 13 subsection 8. And this particular explanation takes recourse to the RBI Act to say that the definition of banking company and financial institution will have to be seen qua the definition of the term under the RBI Act. If you look at RBI Act, the foreign banking companies or financial institutions which are not having any place of business in India are not coming within the scope of this expression banking company or financial institution. So can we say that in absence of such definition under Rule 28, one can take recourse to the explanation available under section 13.8 to borrow the meaning of the term banking company and financial institution? If that be the case, then in a situation where the Indian holding company gives a guarantee to a foreign banking institution, then in that situation, whether that transaction would still get governed by the deeming fiction of 1% that we discussed under Rule 28 Subrule 2, or in that situation, can it go back to the original section 15 to say that it is only on the actual transaction value, which is determined based on the principles that we discussed, the methods that are available. It is only that value which can which can be held to be liable to GST. Now we have issues also on the other side. Let us say someone is required to charge the tax on the borrower, which is a related entity. In that situation, whether borrower can avail the credit. If you look at section 16.1, it permits credit of all the inward supplies which are for use in the course or furtherance of business. 16.2 also has a condition to say that in a situation where one is failing to pay to the supplier within 180 days from the invoice date, then in that situation, the credit has to be paid back to the government, and it can be reclaimed only when the payment happens. However, we have a proviso to Rule 37 Subrule 1 to say to the effect that in a situation where the transaction happens between related persons where there is no consideration, which are governed by Schedule 1, then in that situation, this 180-day condition would not be applicable. It would be deemed that the payment has happened. So in a situation where there is actually no charge of guarantee, it is only by virtue of Schedule 1 Entry 2 that a charge has been created and basis which a GST invoice has been issued. In that situation, one can take recourse to this proviso to say that the 180-day condition would not be applicable. However, where there is an actual charge, then in that situation, the recourse to the proviso may not be available. Then we have a limitation of 16.4. Now, if you see the limitation under 16.4, which is linked with the invoice date. Now, even for the transaction that has happened in the past, today if the entity decides to do the GST invoicing and issues the invoice, then in our view, that invoice would qualify for the availment of credit at the recipient's end, because the limitation of 16.4 is qua invoice date. And since the invoice would be issued today, in that situation, the limitation should not apply. One should also be conscious of the fact that 17.5D is also there. So let us say if an accounting policy which is followed by the recipient is to the effect that by way of availing the loan, if let us say they have constructed an immovable property other than plant and machinery, and the guarantee cost which has been billed or invoiced by the holding company is added to the value of the value of the immovable property, then can in that situation the restriction under 17.5D apply? Here one aspect to be kept in mind is that this restriction applies only qua services which are used for construction. So one can consider here taking a position to say that since these are not the services for construction, these are the services for availing the financing facility. It is by virtue of that financing facility that one perhaps is able to do the construction, but still it is not the direct nexus which is there, and therefore in such situation the credit should still be admissible even if the cost of this guarantee is capitalized to the immovable property in the nature of other than plant and machinery. One will also have to deal with issues concerning export of services. Now, it is quite possible that the holding company in India executes a guarantee to the loans which are advanced to a subsidiary based outside India. In that situation, the requirement would be to invoice to that subsidiary which is outside India. Now, to claim the benefit of export of services, which is zero rated, one of the essential conditions is that the payment should be received by the supplier in the convertible foreign exchange. So, in a situation where let us say the holding company is unable to receive the consideration in the convertible foreign exchange, it is only for the purpose of GST compliance that it issues an invoice in line with the new valuation provision that we have. Whether on that basis itself, whether the benefit of zero rating be available. Issue is certainly debatable for the reason that one can very well in this situation take a position that the requirement of receiving the convertible foreign exchange arises only where there is an obligation to make the payment. The entire transaction which is brought to tax in this context is by virtue of Schedule 1, Entry 2, which expressly says that these are transactions lacking consideration. And we already saw that in the context of 180-day provision, we already have an express rule which says that payment obligation is not to be fulfilled. No credit reversal is required. So in that situation, one may perhaps borrow that reasoning, added with the reasoning that ultimately it is a zero-rated transaction. And therefore, it is an export of service. And in that situation, the benefit of exports or the benefit of zero rating should be applicable. This is in a situation only where the Indian entity is unable to realize the guarantee fee from the foreign entity. In a situation where the Indian entity is able to realize the guarantee fee, in that situation, there would not be any difficulty. The export of service would get fulfilled, all the conditions would get fulfilled, and therefore the benefit of zero rating should be available. So in the end, I would say that the transactions, the implications are not that way easily identifiable. One has to first start with the broader concept of considering whether is it an active participation or is it a passive participation. To determine that aspect, one has to look at the contract of guarantee, one has to look at the letter of comfort, one has to look at other associations that one may have between the related entities, and basis which one has to arrive at the proposition that is there really a supply that has happened between the related entities. If there is a supply, then one has to look at the charging provision when the supply happened. Basis that tax implications are to be understood and complied. One has to also understand the transfer pricing documentation, because ultimately the position that you are going to take under GST needs to also consider the transfer pricing position taken in the income tax law. It should not happen that there is a diametrically different position taken in GST vis-a-vis what you have taken under the income tax law. And one has to also be conscious enough to understand the accounting entries which are passed in the books of accounts of the related entities. It should not happen that by virtue of a certain requirement under the accounting standards, there are certain notional entries which are passed in the books of accounts, whereas the actual position taken in terms of the discharge of liability is something else. So one has to harmonize all the varying aspects, not just consider the GST law and then arrive at the approach or the way in which one can look at this transaction. So in the end, I would say that kindly assess each guarantee on individual terms. Don't apply any straitjacket formula. Don't paint every guarantee with a similar brush. Each guarantee is distinct. Each guarantee is unique, and therefore one has to closely examine and then apply the law. Before taking a position, evaluate all the ramifications. Past transactions, as we already discussed, there is a good ground to say the transactions prior to GST regime, which are still subsisting, should not ideally be liable to tax. Transactions happening between the intervening period, the old valuation rules should take care of those transactions, and transactions that happen on and after 26th October 23. It is only in those situations that the new valuation rules can come into force. Then one has to look at the blockage of fund. It should not happen that by complying with this provision, you end up with worse of situation. As we already discussed, the cardinal principle of related party transaction is to eventually ensure that it is at an open market value. It should not be a value which ultimately is detrimental to the recipient related entity. One has to also consider the aspect of availability of credit. If the credit is available without any other adverse implication, then it is always advisable to take a position where you can avoid any kind of litigation with the department. And at the end, one should also understand the zero rating. This is essentially in a situation where the transaction happens with the entities, related entities which are based outside India. So with that, I end. I again thank the taxman for allowing me this opportunity to share some of my thoughts. This is just a preliminary, I would say, a discussion just to open the minds of all of the participants to sensitize with the issue, to start a process of addressing these issues, because already we have a law in place, already we have a new valuation rule in place. Therefore, it is now the right time for every one of us to really look at this aspect deeply and try to find the actual facts, try to gather all the available evidence, try to understand the provisions as we, and then take a position by being conscious to the various dimensions that we have. So with that, let me just see if I have a couple of minutes to take some of the questions. We already discussed this. So ITC we already discussed. ITC should be ideally available to the recipient entity. Circular in a situation where we have circular happens. So we already discussed that, see, prior to 26 October 23, certainly the liability has to be determined basis the valuation rule in force on the day when the liability to pay tax arose. And therefore, to my mind, there is a good ground to say that the new valuation rule should not apply to the guarantee which have been executed prior to 26th October 23. Circular is also silent on this aspect. Circular nowhere says that the new valuation rule would also apply to the past guarantees. 1%. See, if the GST is applicable, then GST would be under the forward charge. A supplier entity, a guarantor will have to issue an invoice if the transaction is within the taxable territory. In that situation, the supplier will have to issue an invoice charging GST on this deemed value. Term loan, we already discussed that this 1%, whether is it an annual charge or a one-time charge, the express provision of Rule 28 Sub Rule 2 is silent on this aspect. However, looking at how 1% has been taken, from where 1% has been taken, that is the safe harbor provisions under the income tax law, it appears that it should be an annual charge. It cannot be a one-time charge. Guarantee given before GST regime, as I already discussed, we already have section 142(11) clause B, which to my mind takes care of that situation, to say that since it was a transaction prior to GST, the levy or the charging provisions of GST would not apply to those transactions, and therefore on those transactions GST should not be payable. So I think this essentially answers so last question on deemed value of supplier. Supplier does not receive any amount, still is liable to pay tax. See, this is a deeming fiction which has been created by virtue of Schedule 1, entry number 2. And therefore, even if no consideration is actually received, in view of the deeming fiction, if there is a supply, then certainly one will have to charge tax on that particular transaction. So I think this answers all the questions that I had. I again thank Taxmann.